Yes, good morning and welcome to this wonderful SFM revision one more time. So please come to question number 6. Question number 6 is from November 2020 RTP revision tension paper. Okay, because some question give you tension. You are a treasurer of XYZ in the UK. UK is your country. XYZ have two overseas subsidiaries. One subsidiary is in Amsterdam and the other one is in Switzerland. Very good. The surplus position of the funds in hand is as follows, which it does not need for the next 3 months. Understood? So they have surplus funds which they don't require for next 3 months. So that can be invested. That can be invested. Either you can invest in the respective country or you can bring all the money to the head office in UK and the head office can invest. But will be needed at the end of that period. So for calculation purpose take 91 days. For calculation purpose take 91 days. Holding companies in UK, it has 1,50,000 pound. Swiss subsidiary has 1,996,154 CHF, the currency of Switzerland, Swiss franc, and it is written as CHF. Okay, and Dutch subsidiary means Amsterdam uses euro. Exchange rates are as follows. What is exchange rate for euro? This is exchange rate given for which currency? Euro. Exchange rate is for euro, spot rate, and it is given in terms of pound. So it's basically pound per euro. Pound per euro. So you will read it as pound per euro. This is the buying rate and this is the selling rate for pound per euro. And then you are given 91-day points. These are the premium. These are the premium. Why it is premium? Why it is premium? Reply please. Why it is premium? Because it is in ascending order. Very good. It is in ascending order. Then they have given you spot rate in bracket pound, CHF buying rate, selling rate. So this you will read it as CHF per pound. This you will read as CHF per pound. This you will read as CHF per pound. And 91-day points 0.0242, 0.0228. My question is whether pound is at a premium or at a discount. Pound is at a premium or discount. Please reply. Look at these premium points. Look at the swap points. Pound is at a discount. Why? Why it is at a discount? Because it is in descending order. Because it is descending order. So while calculating the 91-day forward rate, you will deduct discount. And here while calculating the 91-day forward rate, you will add premium. So very interesting question. This is premium, this is discount. So accordingly, you will do the adjustment. Okay. So are you ready for the question? This question is very important. 91-day interest rate on per annum basis. Underline per annum. So wherever you have to do the calculation, you have to multiply 91 by 365 because 360 because the number of days are given as 360. So 91-day interest rate on the deposits in the money market are as follows. So these are the interest rate for pound, euro, CHF. And the interest rate will be according to the amount of the currency. Is it right? If you invest between 0 to 2 lakh, these are the rates. Between 2 lakh 1 to 10 lakh, these are the rates. Like this. Like in India, bank also gives you FD rates. Do you know that? Bank says if you invest for 91 days, 6.5. 1 year, 8%. More than that, 8.5. So that is how even in the foreign countries, the interest rates on deposits are given. Do not calculate slab-wise interest. Do not calculate slab-wise. Because one student had asked me in the earlier batch that can we take slab-wise that first 2 lakh, this is the interest, after that this is interest. This is not income tax. Have you ever invested in a bank FD? So do they charge slab-wise interest or according to the amount you invest and the period for which you invest? According to that, on the whole amount they will apply the interest. So we'll also apply the interest on the whole amount. We will not go slab-wise. So for the clarity of doubt, no slab-wise interest. You have to just see which is the right line and that you will follow. For example, this holding company is 1,50,000 pounds. So 1,50,000 pound will fall into this range. So interest rate applicable will be 1%. Another example, suppose CHF is 1,996,154. CHF will be in which range? Third range. So the interest rate applicable will be 0.5%. Very good. Like this we will do. Next line. Very good question for checking the knowledge of a student. You have been approached by your banker wherein the above mentioned surplus was lying, requesting you to swap the surplus lying with other two subsidiaries and place them in deposit with them. So one bank has come. Bankers are very smart. They found that you have got so much of surplus. So they are telling you, don't keep money with this Amsterdam and Switzerland subsidiary. Bring the money into your country, that is UK, and invest with us. So that is the proposal of a banker. In that case, you will have to bring the money first into UK and invest with UK bank, the entire amount. One option is called decentralized investment. Sir, what is decentralized investment? Each subsidiary or holding company will invest on their own. And centralized means all money will be brought at one place, holding company, and then the holding company will invest. So right now one calculation will be the value on maturity if each subsidiary follows decentralization approach. And the second calculation will be if they follow centralization approach. Determine the minimum interest rate per annum. This is your reverse question. Determine the minimum interest rate per annum that should be offered by the bank to your organization so that your organization is ready to undertake such swap arrangement. So when you will be ready to undertake such swap arrangement, when you will get the same maturity value which you will get by decentralization approach. When you will get the same maturity value which you will get by decentralization approach. Is it right? So you will have to find out what interest rate the bank in UK should offer so that you will take the proposal of that bank. So you will say, I will take your proposal if you also give me the same maturity amount which I can get myself by investing separately by each subsidiary and the holding company. So I will be indifferent only if I get the same money from you which I can get myself. Is it right? So what will be my first task? My first task will be to find out if each party invests on their own, how much will be the amount on maturity? Is it right? How much will be the amount on maturity? So some simple calculation we will perform now. Students are requested to start writing. We will take the amount available with them. add interest for 91 days. That will give me amount on maturity and convert into pound so that we can take the total. Because to take the total, I need same currency. You're right. So come on, write down. Step 1, calculation of cash balance in pound. Calculation of cash balance in pound after 91 days. Calculation of cash balance in pound. Because why in pound? Because I have to compare with the other option also. So to add the three currencies, you have to first bring them down into one same currency, that is pound, because pound is the holding company's currency. So start writing, please. First write down calculation of cash balance in pound after 91 days if each party acts independently. If each party acts independently. If each party acts independently. Is it right now? So write down holding company in bracket UK, Swiss subsidiary and Dutch subsidiary. So first point A would be naturally surplus at the beginning. Surplus at the beginning. So go to your question, you will find surplus at the beginning is given pound 1,50,000, CHF 19,96,154 and Dutch subsidiary has a surplus of 14,50,000. Second point again should be interest rate applicable per annum. You will tell me, yes, come on, yes, students, please reply. What is the interest rate applicable to holding company if it has to invest 1,50,000 pounds? One student has replied 1%. You are right. Swiss subsidiary. Come on, Swiss subsidiary. Look at the CHF column and look at the range 10 lakh to 20 lakh. Is it 0.5%? Very good. Come on, next. Who will answer Dutch subsidiary? Yes, yes, yes. Come on. 2%. Yes. 14,50,000 will come in the third slab. So 2%. This is just to find out the applicable rate that is given. All figures are not relevant. They are testing your understanding of the question. Now calculate interest for 91 days. Calculate interest for 91 days. Take on your calculator 1,50,000 into 1% into 91 divided by 360. 91 divided by 360. Yes, Rishabh, you are right. Come on, next. Around 379.17 you are getting. Okay, try the next one. Try the next one. Next column is how much? Simple interest for 91 days. 2522.92 you are getting. 2522.92. Try the third one. Try the third one. Anybody for Dutch subsidiary? 14,50,000 into 2% into 91 by 360. Yes, what is the answer? 7330.56. Very good. Point number D. Amount received after 91 days. Amount received after 91 days, you will add the principal A plus interest point C. Write in bracket A plus C. A plus C. Sidana is right. Come on, Sidana. Holding company maturity value of deposit. A plus D without calculator. 150,379.17. This you can do without calculator. Now try the next one. Dutch subsidiary, Swiss subsidiary first. 1998676.92. You are right. Keep writing the currency also CHF. Now tell me Dutch. Without calculator you will do last one. 1457330.56. Are you getting? Say yes. Now the next task is to convert all these numbers into pound. First number is already in pound. So I will just write exchange rate 1. Even if you don't want to calculate the first column, it's okay. So please students, write applicable exchange rate after 91 days. And if you can get this right, out of 8 marks, you will get at least 4 marks. If you can manage these two rates. So I am asking you question. What is the applicable exchange rate between pound and CHF? Pound and CHF. Applicable exchange rate, forward rate between pound and CHF. Give me the correct answer. I will send you one e-chocolate. One student has given 2.3098. 1.2. So which rate you have to use? So first you look at the rate between pound and CHF. The rate is per pound. The rate is CHF per pound. So imagine you will bring CHF. Okay? So you will sell CHF and buy pound. What bank will do? Sell pound. So sell pound means bank will apply the higher rate, that is 2.3326. But I have to find 91-day rate, which is at a discount of 0.0228. So 2.3326 I will take minus 0.0228. 2.3326 you can see selling rate. Below that 91-day 0.0228 is given. Minus that. So your answer would be 2.3098. 2.3098. Mehul is right. 2.3098 was the right answer. I have shown the calculation also on the screen. Please write the calculation. Later on you'll forget. Preeti is wrong. Preeti, you have to change your answer. Okay. Now my question is again, what is the rate for Dutch subsidiary? Rate between euro and pound. Rate is for euro. So you will bring euro and you want to buy pound. What bank wants to do? Bank will sell pound but purchase euro from you. So rate is for euro. Rate is for euro. Rate is per euro. Am I right? Bank is purchasing euro from the customer. So bank will purchase euro at a lower rate. That is your 0.6858 plus the premium for buying rate 0037 plus 0.0037. So the answer would be 0.6895. Rishabh is right. Very good. So I am going to send you one electronic chocolate now. This is the chocolate. These are the wrapper. Cadbury is written here. Okay. Enjoy. Yes. And many students get it wrong sometimes. Not everybody. So that is why I took this question. It has lot of data. Yes, Rishabh, enjoy your Cadbury. Amount in pound. Convert amount in pound. First one will be same. First one will be same. Now again $1,000,000 question. What is the pound equivalent of this CHF figure? Pound equivalent. The student is saying, sir, the chocolate is yummy. Wow. I will send you some more after some time. You can distribute in your society also. Yes, answer the middle column. 865303.02. Very good. One more. Last column. Last column. Are you multiplying or dividing? You have to multiply. You have to multiply. That is the trick. The amount is in euro. The rate is per euro. When the rate is per euro, the answer will be 10,04,829.42. Yes, those who have replied, the answer was right. So what are the two possible mistakes in this question? One possible mistake is using a wrong rate here. Second possible mistake is instead of this needs to be divided and this needs to be multiplied, because the rates are given in different ways. One is rate per pound, one is rate per euro. So when the currency is already in euro and rate is euro, you need to multiply. But when the currency is CHF and the rate is per pound, then you need to divide. So now you tell me the total amount in pound after 91 days. Take the total of these three figures. If you manage funds on your own in a decentralized manner, the firm will have after 91 days, the firm will have after 91 days 2020511.61 approximately. After decimal, if there is a difference, don't worry. Before decimal, it should be right. Yes. So this is what I must get from a banker also. This I should get from a banker also, who is telling me that you please come and deposit with us. So I will tell him, boss, I can earn this much myself. So you should also give me the maturity value at least equal to this much. Yes, minimum. Then only I am motivated to invest in your bank. Now write down step number 2, swap to sterling. So now what I'll do, I'll bring all the funds before on the first day to UK only using spot rate now. And then we'll see how much interest do we need and find the rate of interest. Okay. Are you ready? Right. Step 2. Step 2, everybody should try. This is a batch for your exam purpose, and this is one of the most important questions. So first you write down, right hand side, write down, don't write rupees, write down amount, write down amount, cut the rupees, because we are used to writing rupees every time. When we'll go to moon also, we'll write rupees there also. Convert euro into pound. Convert euro into pound. How many euros are there? 14,50,000. And what is the spot rate? The spot rate is 0.6858. I will use 0.6858. We will sell euro to the bank. Bank will buy euro from us. The rate is per euro. The rate is per euro. So the lower rate will be used because bank is buying euro from the customer. Answer please. 994410. Okay, now I will give you a chance. Convert that Swiss subsidiary CHF figure into pound at spot rate. CHF into pound. Convert CHF into pound So this time the rate is per pound. This time the rate is per pound. So the bank is so this I think I have written a wrong symbol here. It should be multiply and it should be divide. Oh, my mistake. Human mistake. Okay. Human beings are bound to make mistakes. Answer is right. Okay. Answer is right. So this is just a typing error. Calculation was right. So now please write down how much will be the pound you will receive. 855,763. 855,763. I have rectified. You also rectify. So now amount with holding company is already in pound. 1,50,000. Is it right? 1,50,000 now. So tell me the total. Who will give me the total first? The one who will give me total first will get e-chocolate again. Total amount is 2,000,173.53. Very good. But this time the student in the classroom has given the answer first. You will get the e-chocolate, okay? You will get physical chocolate. Now write down desired amount at the end of 91 days. Desired amount at the end of 91 days. Go to step 1 total. Go to previous step, look at the total. Yes, students, please reply. What was the answer in the previous step? 2,020,511.61. So you want this amount the bank should give you on maturity. So how much interest the bank should give you on maturity? This is you will invest today. This is your maturity value. So the difference is your interest. The difference is your interest, right? Interest required, E minus D. Interest required, E minus D. Come on, come on. Please take the difference, 20338.08. Now I am going to ask you a school level question. This is the principal amount. This is the interest amount. Number of days are 91. What is the rate of interest in your 4th standard simple interest calculation you have done? So this is the interest amount, this is the principal amount, this is the time. Can you not find me the rate of interest per annum? Start on your own. What is the rate of interest? Everybody, come on. This much you should be able to do. Now your exam is very close. So the required interest will be interest amount divided by principal into 361 divided by 91 into 100. The answer is, come on everyone, the answer is 4.023%. That is also right. 4.022 is also right. So this was a very important question considering so many currencies, so many rates are given. Choice of the correct number is important. So conclusion, write down. The minimum rate to be offered by the bank is 4.023%. The minimum rate to be offered by the bank is 4.023%. The minimum rate to be offered by the bank is 4.023%. Per annum. You can write per annum. 2.023% per annum. Very simple if you use the correct rates. That is we have done. We have converted everything into pound and then invested at this rate. You are saying the same thing. But the question is what interest rate the bank should offer. So I have to answer what is asked. Okay. So that is what the other student is also asking. Can we convert into pound in the beginning and then compare with the other answer? So if you suppose invest in pound directly, how much money do you have? So normally the first paragraph says the surplus position of the fund in the hand is as follows, which it does not need for next 3 months but will be needed at the end of that period. So that means each subsidiary will keep the money with themselves only and they will invest on their own. So we have to basically compare decentralization with centralization. Is it right? The other option, other answer which you want is, suppose I have this much amount at the beginning and if I invest in pound, I'll get 5.38% for 91 days. Oh, that is okay. Then in that case, the answer is 5.38% only. There is no calculation required because you will also get 91 days is same for both options. Either you invest or the bank will give you 91 days interest. Then in that case, your answer will be 5.38% only. There is no need to do any calculation. The moment you find you exceeded 20 lakh, you will get 5.38% on your own. That is what the banker should also offer you. So from the overall design of the question, it appears you have to see if each party invests independently, then what will be the amount you will receive on maturity. Okay. Otherwise, there is no need to give forward rates, etc. Question number 7. This question is very important because it has been asked only once and it is a very different type of question. Okay. November 2019 exam 007. A German subsidiary of US based MNC has to mobilize, underline German subsidiary of a US based multinational company has to mobilize 1 lakh euro working capital for next 12 months. 1 lakh working capital for next 12 months. It has the following options: loan from German bank 5% per annum. So if you borrow in your own country, how much you have to pay? 5%. If you borrow in USA, 4%. If you borrow in Switzerland, you will have to pay 3%. So from the rate it appears this is better, but wait, there are other issues involved. Okay. Banks in Germany charge an additional 0.25% per annum towards loan servicing. So basically what will happen, if you borrow from Germany, it will not be just 5% interest, but a German bank also charges 0.25% for servicing the loan. Whatever are the cost of servicing the loan, they charge 0.25%. There is one more problem. Loan from outside Germany attract withholding tax of 8%. Loan from outside Germany will attract withholding tax of 8%. What is withholding tax? Whenever the payment will be made, whenever any payment is made to a foreign country, the domestic country will have to deduct 8%. The domestic country will have to deduct 8%. This US parent bank is charging 4%. But they will say, I want 4% in my account. So who will have to bear the burden of this withholding tax? German firm. So German firm will have to actually give them a higher interest rate so that after deducting 8%, they should get 4%. Is it right? Like my office staff says, sir, I want 17,000 rupees salary, but I have to pay 200 rupees profession tax also. Then what I have to do? How much salary I have to offer him? On paper, I have to give him 17,200 rupees salary. Because he says, I have negotiated with you 17,000 on that day. You said I will get 17,000. I want 17,000 in my account. So similarly, the US bank is saying we want 4% interest. So you have to bear the burden of withholding tax. So my effective cost will actually go up. 4 divided by 0.92. So that when I will pay that higher amount and deduct 8%, actually the other party will get 4% only. Is it right? Similar to your office example, my office example. Now next point, if the interest rates given above are market determined, examine which loan is most attractive using interest rate differential. Which loan is more attractive using interest rate differential? One more problem is that these are different countries, Germany, US, Switzerland. So interest rate parity theorem will also apply. Interest rate parity theorem, because you will benefit on the exchange rate, interest rate, you will benefit on the interest rate, but there is a problem. Exchange rate after 1 year would have changed. Exchange rate after 1 year would have changed. So you have one more cost, hidden cost, and that is your exchange premium that you will have to pay at the time of repayment. At the time of repayment, if you suppose borrow $100 today, convert into euro, after 1 year when you will go to pay, the rate of exchange will not be the same. Why rate of exchange will not be the same? Because interest rates are different. If interest rates are different, by the time you go and make the payment of that principal amount, you will have to pay a higher amount depending upon which country has a higher interest rate. So Germany has a higher interest rate. So as per interest rate parity theorem, German currency will depreciate. Foreign currency will appreciate. So there is one more cost that you have to add, and that is the premium. Yes. Three costs. One is 4%, one is withholding tax, and one is that premium. So that premium you will calculate as per interest rate parity theorem. Is it right? Oh my God, we never visualized that this question has interest rate parity calculation also. If you are different countries with different interest rate, exchange rate will also change. That is called interest rate parity theorem. Okay. In this previous example, one student has said that if we follow 5.38%, there will be a problem on after 3 months we'll have to send the money back to their country, and that time the exchange rate can be different. So that is why you have to also ensure that you get the same exchange rate. Okay, and that is why first you computed the individual figure and then compared with the consolidated figure. So write down answer of question number 7. This also you write important new question not usually taught in the regular class, but it has been asked. So if they have asked in earlier exam, they can ask in the next exam also. Calculation of net cost under various options. Calculation of net cost under various options. Please write down. Calculation of net cost under various options. As far as German is concerned, it is simple because you are a German subsidiary and you are borrowing in Germany. So exchange rate fluctuation will not matter here. Right? Start writing loan from German bank, and here my calculation is simple. 5% is interest and 0.25 is loan servicing charges. So that gives me 5.25%. Step option 2, write down. Option 2, loan from USA parent bank. Loan from USA parent bank. Loan from USA parent bank. Right hand side amount. Right hand side amount. Effective rate of interest. Effective rate of interest. %4 divided by 1 minus 0.08. I will have to pay a higher amount so that the withholding tax is also covered. After deducting withholding tax, the US bank should get 4% in their pocket. Is it right? So I will have to actually pay 4.35%. 4% plus also we have to pay with withholding tax, and write down the premium on USD. Yes. So first 4.35 when you will go to pay, if you take 8% of that, it will come to 0.35. 0.35 will be deducted and 4 will be remitted to the other company. Okay. And then you write down premium on USD using interest rate parity theorem. Premium on USD using interest rate parity theorem. Using interest rate parity theorem. Premium on USD using interest rate parity theorem. So one of the formulae you have learned in interest rate parity theorem is RD minus RF upon 1 plus RF. RD minus RF upon 1 plus RF. So RD means interest rate in domestic market, which is 5%, minus interest rate in USA 4%, divided by 1 plus 0.04. So how much is that? 0.96. 0.96. Net cost. Net cost will be under US parent bank option, net cost will be A plus B, 5.31%. 5.31%. Is it right? This formula we have discussed in the regular class and we have derived it also, but now we don't have time. Write down next line. Option 3, loan from Swiss bank. Loan from Swiss bank. Loan from Swiss bank. Same calculation. First point A, effective rate of interest. Effective rate of interest. Effective rate of interest here will be 3% divided by 92%, 3.26, and premium on Swiss franc, premium on Swiss franc, premium on Swiss franc will be 1.94. 1.94. Very good. So what is the net cost? Come on, net cost Swiss bank 5.2%. Very good. So one has to look at the issue from various angles. Not just the interest rate, but also whether any tax issue is involved, whether any exchange risk is involved, and then one has to decide which is cheaper to borrow from. Now you compare the three answers and tell me where will you borrow from, which is the lowest figure, which has the lower effective cost. Swiss bank. One day when you will join the Adani enterprise and they will ask you to borrow from different countries, keep this question in front of you, okay? And this will help you to decide. Adani ji will give you 10 crore rupees bonus. So write down the conclusion. Loan from Swiss bank is the best option because they are searching for loan, okay? So help the great Adani is the best option as the net cost is lowest. Why? Because the net cost is lowest. Understood? One more important question. Highly repeated question, write down. Highly repeated question. 2-3 times they have asked in exam also. And 3-4 times it has come in MTP, RTP. This question is everywhere. Question number 8. DUM Limited. If you write correct answer, your mark sheet will boom. If you write wrong answer, your mark sheet will doom. Okay. So DUM Limited is an export business house. Underline the word export because the answer will completely change if it was import. So as a homework you can try assuming it was an import business house. Okay. The company prepares invoice in customer's currency. So there will be a problem of exchange risk. It daters of $48 lakh is due on 1st April. So what is the maturity date, due date of this amount receivable? 48 lakh. So this is a question of amount receivable. Are you getting? Now next is market information on 1st January 2020 is. Today is 1st January. And the payment will arrive on 1st April. So 3 months gap. Now lot of information is given, some information may not be useful. Okay, like exchange rate is given, spot rate, 1 month forward rate, 3 month forward rate. Are we interested in 1 month forward rate? Are we interested in the spot rate? No, because my payment will come after 3 months only. So I will have to book a 3 month forward contract. And then they have given you information about future, currency future. So this is a question on currency future. Okay, that means it is used for hedging purpose. And see the rate they have given, US dollar per INR. And what is the contract size? Rupees 288,16368. That means one lot is equal to, one contract or one lot is equal to 2 crore 88 lakh 16,368. Yes, make it a small correction. That is why I have written in red font. This number is 288. In your book it is typed 258. So kindly rectify. Have you rectified? 288. Typing mistake. 1 month future is irrelevant because I will book a future contract which will match with my maturity or near my maturity. So 3 months. So this is the rate. Now this will be USD per INR. This will be USD per INR. Understood? Next line. Initial margin. When you take a forward contract, sorry, future contract, not forward, future, the exchange requires you to deposit initial margin. The exchange requires you to deposit initial margin. Again, 1 month data is irrelevant. Unnecessary, they have given to confuse you. Extract money from you. Extract money from poor student who have already dedicated his youth for this course. 3 months is relevant. So 3 months. Initial margin for one contract is 32,500, but because initial margin is paid at the beginning and we are going to do calculation at the end, there will be a 3 month interest loss on initial margin. There will be 3 month interest loss on initial margin because all cash flows I am going to calculate after 3 months. Initial margin will be paid today. So the interest loss on that is also a cost under future contract. The interest loss on initial margin is also a cost under future contract. If it is given, you have to consider it. If it was not given, then interest on future contract is ignored. On 1st April 2020, the spot rate is given and the currency future rate is given. This is on maturity, not spot. So when you go to the maturity date, that day you find that in the market, the rate between dollar per rupee is 0.01384, and on that date, the currency future is also trading at almost the same rate, but it is different. So this currency future contract which you are going to take, to calculate the gain or loss, you will apply the future rate available. You will apply the future rate available. Okay. And whatever amount you will receive, that amount you will convert at spot rate after 3 months. And on currency future, you will get the difference. Recommend as to which of the following method would be most advantageous to Doom Limited. Now, if you are an exporter, the answer is higher of the three. What are the three options in front of you? Either you can take a forward contract and book the rate at this amount, matter closed. Using future, so you have to take a future at this rate and don't hedge, just wait. So if you wait, you will get the conversion at spot rate on maturity. You will get the conversion at what rate? At spot rate on maturity, because you have not done anything. So whatever is the spot rate on 1st April, this is the rate, at that rate you will convert. Now this is a question of currency future which involves several steps to solve. So first, what you do to make your task easier, I have drawn a flow chart. Please draw this flow chart in your notebook. Please draw this flow chart in the notebook. I will explain once you have drawn. I'll just come after 45 seconds. Okay. In the meantime, please draw the diagram. I will come back in 45 seconds. Okay, I am back. So have you drawn the diagram? First tell me yes or no. Everybody, those who are learning from home, have you completed the diagram? Yes. So now you see in this question, what position I have to take, I have to decide that. Okay. So whenever you have doubt in future, you can refer this chart. So first you identify who is the party. Is he an exporter or is he an importer? Is it right? So if it is he is an exporter, what is the risk involved? The risk is that the risk is that foreign currency may depreciate. If foreign currency depreciates, if suppose dollar depreciates and you are an Indian company, you will get less rupees. Or you can also say home currency may appreciate or home currency may appreciate. Understood? So to an exporter, the risk is that the foreign currency may depreciate or home currency may appreciate. And if you are an importer, suppose same question is given from importer's point of view, what is the risk? The foreign currency may appreciate, you may have to pay more if foreign currency appreciate, or it is same as saying that home currency may depreciate. Now I will come back to exporter, which is our question. If the future contract is denominated in foreign currency, if the given future contract is denominated in foreign currency, that means home currency per unit of foreign currency is given. Home currency per unit of foreign currency is given. Then you have to sell future. Then you have to sell future to hedge the risk. Because if there is a depreciation in foreign currency, the loss in foreign currency will be compensated by the gain in the future. If you have taken a short position in future and if it is dollar, the loss in this transaction will be compensated by the profit on future. That is also not relevant to us in this question. This is relevant to us in this question. We are an exporter. The future contract is denominated in home currency. So this you tick mark, which is applicable for this question. Future contract is given as dollar per rupees. Is it right? Future contract is given as USD per rupees. So now what is my risk with respect to home currency? My risk is that home currency may appreciate. My risk is home currency may appreciate. If home currency is going to appreciate, I will lose. Then what is my position in the future required? Buy future, long position in future required. So the loss here, the loss will be compensated by the gain if you buy future when future is denominated in home currency. Is it right now? Yes. So one Mr. Rishabh has also said the same thing, long the future in this case. So basically student can tick mark these two things which is applicable. But suppose in your exam they give you importer. If the future is denominated in foreign currency, the risk is that foreign currency may appreciate. So buy future. If future contract is denominated in home currency, the risk is that home currency may depreciate. In that case, sell future. So one more time I will explain. We are here. This is the contract and this is the strategy I will follow. Now write down one more note. Steps in solving currency future hedging problem. Please write steps in solving currency future hedging problem. I have found students having difficulty here. So I am going to first give you a note. How to solve currency future hedging problem. How to solve currency future hedging problem. So step 1, write down, check the exposure. Check the exposure. Check the exposure means what is the firm afraid of? What is your risk? What is your risk? Accordingly, the firm should buy or sell future. Accordingly, the firm should buy or sell future. For that, I have already given you a diagram. So write in bracket refer diagram. The answer depends on whether you are exporter or importer. The answer depends on whether future contract is denominated in home currency or foreign currency. Accordingly, we will buy or sell future. Step number 2, write down future maturity. Step 2, write down future maturity. Step 2, write down future maturity. Step number 2, write down future maturity. Always choose future maturity equal to or just before exposure maturity, or just before exposure, near to the maturity. Is it right? Like in our question, why I have given you this note? In our question, 1 month future is also given, 3 month future is also given. So afterwards you should not have a doubt. My currency will come to me on 1st April. So I will take a future contract which will also mature around that period. So I don't have the risk, or I don't have much risk. But in this question that problem will not be there because both are April. Step number 3, calculate number of future contracts. Calculate number of future contracts, because you can't buy future contracts in fraction. Okay, you don't get exact amount of future contract. You have to either round it off to the lowest or the highest side. Write down. Student has to write. Later on you will not remember what did I say, but your notes will remind you what I did say, what I said. So how do you compute the number of future contract? Student will follow this highlighter or pointer now. If exposure currency future are available, if exposure currency future are available. In our question, the exposure currency is dollar. The exposure currency is dollar. We have to receive dollar. So in that case, if the future was also denominated in dollar, my life is easy. Exposure divided by lot size. Suppose this was 40 lakh dollar and the lot size is $10,000, then my life is easy. But this formula I will not apply. Sir, why? Because my lot size is not given in dollar. My lot size is given in rupees. My lot size is given in rupees. So next formula will be applicable in this question. Case B. Case B, write down. If exposure currency future are not available, which is applicable to our question number 8. Which is applicable to our question number 8. If exposure currency future are not available, exposure is in dollar, future is available in Indian rupee. So what do I do? Write down number of contracts equal to, below, left side below, number of contracts equal to exposure equivalent based on future price exposure equivalent based on future price. So my exposure is 48 lakh dollar. I will find out the equivalent amount in rupees. 48 lakh dollar is equal to how many rupees? For that I will apply the future price. Is it right? So that will convert 48 lakh dollar into rupees and divide by lot size. Lot size is given 2 crore 88 lakh 16,368. Okay. So this will give me number of contract. Step number 4, write down. Step number 4, please write down. Settlement on maturity date of exposure. Settlement on maturity date of exposure. This should be taught line by line so that any time you revise, you will understand. Whatever we speak in the class, you will forget after a few hours. But whatever you write in the notes will remain with you forever. If your notes are there forever. Don't sell your notes. Whatever basics you are learning will be required for the rest of your life. Till death. Okay. That is equal to rest of your life only. Settlement on maturity date of exposure. So how do you settle the amount? Square of the future. Square of the future. In our question, we have entered into a future contract. Then after 3 months, the future rate is given. The difference will be your gain or loss. And calculate the gain or loss. And calculate the gain or loss. Be careful about the currency. Whether the loss or gain is in dollar or the loss or gain is in rupees. So here also the student make mistake. They write a wrong currency here. When we will solve it, that time I will explain this point again. Be careful about currency. Then you will receive the dollar. Need the payable or receivable by buying spot or sell the receivable spot. So if you are an importer, then you have to buy spot. If you are an exporter, you have to sell spot. That is why in the question spot rate on 1st April is given. So to us this line is important because we are exporter in this problem. But if the question is of importer, then this line will become important. Now next line, write down. Calculate interest expense on initial margin blocked. Calculate interest expense on initial margin blocked. Calculate interest expense on initial margin blocked. If initial margin is given to you. In some questions they don't give you. So then ignore. Then write down next line. In case of importer, just 2 more lines, then we'll solve. In case of importer, which is not applicable in this problem, in case of importer, final answer is home currency outflow. Final answer is home currency outflow. Final answer is home currency outflow. And in case of exporter, the final answer is home currency inflow. So your last answer should be inflow in rupees. And if you are comparing with different options, then the one which will give you highest inflow in rupee would be taken, would be selected. Understood now? Now I am going to apply the theory into practice. Write down answer. In the exam you start from here. Previous 2 slides were irrelevant. So answer starts from here, from exam point of view. So dear students, write option 1. Option 1 is enter into 3-month forward contract. Enter into 3 months forward contract. I am waiting for this question to be asked again in the exam because it is repeated in several RTP, MTP, old syllabus, new syllabus. Point A, write down amount receivable in dollar, 48 lakh. Point number B, write down 3-month forward rate, 3-month forward rate, 3-month forward rate dollar per rupee, 3-month forward rate dollar per rupee. Just look at your forward rate 3 month, 0.013889. Can you see that? So convert into rupees now. This is dollar, 48 lakh dollar. And this is rate per rupee. So when the currency is in dollar but the rate is in rupee, you will divide. One student is saying this is my favorite question. Very good. So divide, you will get 34 crore 55 lakh 97,235. Are you getting this answer? Check it again. 34, 55, 97, 235. Now write down step number 2. Option 2 write down. That is the purpose of taking this question, to explain to you how the future contract gain or loss is calculated, how cash flow are calculated. Are you ready? Yes. Option 2 future contract. Option 2 future contract. I will give you a note for understanding purpose. Note not required in the exam. If you don't have time in the exam, then you can skip this note. This is for your reference, for your understanding, for your future revision. The firm is afraid of dollar falling, that is rupee rising. That is rupee rising. It should buy rupee future. So when you are afraid that rupee will go up, the appropriate position will be buy rupee future. It should buy rupee future of April maturity. Underline April. Okay, they have given you 1 month also, but that is to be ignored. April maturity at, look at your question again, 0.013881 dollar per rupee. Then your query can be why we have taken April, because why we have not taken February. The answer is, since receivable is on 1st April, the firm should choose April future contract. Since receivable is on 1st April, the firm should choose April future contract. Now you see, the exposure is in dollar. Exposure is in dollar, but the contract is in rupee. So you have to find out rupee equivalent of USD exposure. What is 48 lakh dollar equivalent to? For that you will apply the future rate. For that you will apply future rate, 0.013881. Now please take your calculator and check this. Is right? 34, 57, 96, 412. Say yes. Step 2, number of contracts. Step 2, write number of contracts. Number of contracts will be your exposure in rupee divided by 1 contract size. I am going to ask you to check whether you are listening or not. How many future contracts you have to buy? How many future contracts you will have to buy? Take the previous answer, divide by 28816,368. So 12 contracts. If you are getting in fraction, round off. 12 contracts you have to buy to hedge yourself. Is right 12? Yes, 12 number of contract is right. Now right below, step 3, profit on squaring of future. Profit on squaring of future on 1st April. Profit on squaring of future on 1st April. What is the answer? Now you have entered into a future contract at this rate 0.013881, correct? Bought. And now the future rate on 1st April, future rate is 0.013893. So the future has gone up. So if you have bought future, if the rate goes up, even though it has gone up by a very small number, but it has gone up, so you are going to make profit per rupee. You are going to make a profit per rupee. So this is the profit in dollar per rupee. The difference is the profit in dollar per rupee multiplied by one contract size and multiplied by 12 contracts. So that will give you total profit in which currency? Dollar. The profit you are calculating is dollar per rupee. So the total profit will be total dollar profit versus so many rupees. Is it right? So write down the calculation. Write down, this is an important calculation now. This is the 1st April future rate. This is the contracted future rate. So the difference between the two is our profit because the rate has gone up and we have taken a long position. This is one contract. This is 12 contracts. So the answer is $4149.56 gain. $4149.56 gain in future contract. Now step number 4, write down. Step number 4, total amount available after 3 months. Total amount available after 3 months. Total amount available after 3 months. Total amount available after 3 months will be, understand this point, $48 lakh you receive from customer. 4149.56 you will receive from profit on future. So now you have with you 48,04,149.56 So you are holding so many dollar on hand on 1st April, 48,04,149.56. This you convert into rupees now. Step 5. Come on student, reply please. Rupee inflow after 3 months. Rupee inflow after 3 months will be at spot rate. Take this dollar, go to the market, sell dollar in the market. The spot rate, this is the spot rate in the question last 5th line. So you will get how much? You will have to divide because amount is in dollar, rate is in rupees. So divide, you will get 34,57,71,524 rupees. Very good, Rishabh. You seem to be a highly talented student. Now write down interest on initial margin blocked for 3 months. You have to take initial margin of 32,500 because the 3-month future contract has an initial margin of 32,500 per lot. It is per lot. You have bought 12 lots into 12 lots. Very good. Into 9% interest rate. 9% interest rate, and the time is 3 months into 3 by 12. Time is 3 months. So finally, your interest obligation would be 8775 or opportunity cost, whatever you want to say. This amount you have to deposit at the beginning. This cash flow is after 3 months. To make them comparable, I will have to also consider the interest lost 8775. So finally my last step 7 for future contract, net inflow on 1st April, net inflow on 1st April, net inflow on 1st April, net inflow on 1st April. Come on, you have to deduct it because this is your opportunity cost. So the answer student has given 3457624749. Very good. So this is my inflow under future contract. This is inflow under future contract. Okay. Now one more option is don't do anything, no cover. Wait for 3 months. Wait for 3 months, not hedging the currency risk. Option 3, not hedging the currency risk. Right hand side, write down. Right hand side, amount. Point A, amount receivable in dollar 48 lakh. Amount receivable in dollar 48 lakh. Point B, write down 3-month spot rate. 3-month spot rate dollar per rupee. 3-month spot rate, or you can write spot rate after 3 months. Spot rate after 3 months. Spot rate after 3 months. 0.013894. So what is the amount receivable after 3 months in INR? Amount receivable in INR after 3 months. Amount receivable after 3 months. 345472,866. Very good. Right? Compare the 3 answers. Which is lowest? Sorry, which is highest? Which is highest? You are an exporter, so I will maximize inflow. So write down future is preferable. Yes, second one. Future is preferable because rupee receipts. Because rupee receipt is highest. Very good. Those who are saying rupee future is better, amazing, wonderful. Because rupee receipt is highest. Is it right? Now we'll take one question on economic value added. Now we'll take one question on economic value added, EVA. Economic value added means whether the firm is genuinely efficient or not. Whether the firm is genuinely efficient or not. So suppose a firm says our net operating profit after tax is 100 crore. Is it efficient or inefficient? Or data is not sufficient? Data not sufficient. Only profit is not enough. We are applying capital in the business. There is an opportunity cost of using capital in the business. So I will also calculate what is called capital charge, which is capital employed into weighted average cost of capital. Is it right? Suppose this comes to 120. So the difference is EVA negative. So even if you are profiting 100 crore, even if you are making a profit of 100 crore, but if your EVA is negative, you are a wealth destroyer. You are a wealth destroyer. But if EVA is positive, it means you are generating profit more than cost of capital, and you are a wealth creator. So that is the concept of EVA. Now we'll take one example from RTP November 2021. Write down important. Similar question they ask in the exam. Not very different. So we'll solve it and I will explain the concept of EVA again with the help of the example. Question number 1. On EVA, STR Limited's current financial year income reported is net income after tax at rupees 50 crore. So they have given you PAT 50 crore. Following is the capital structure at the end of the current financial year. So you have debt 80 crore on which you are having to pay interest at the rate 11%. Then equity means share capital plus reserve 250 crore. Total of these two, which is my invested capital, is 330 crore. So this is my capital employed. I have to multiply it by weighted average cost of capital to get the capital charge. Is it right? Weighted average cost of capital is KD into WD plus KE into WE. Now, weight of debt and weight of equity can be easily calculated from the balance sheet. This is weight of debt, weight of equity. Is it right? Cost of debt also you can calculate easily. 11% is the interest rate and 30% is the tax rate. So cost of debt you will get. But cost of equity will be calculated by applying this data, and which is tricky. Asset beta is given. Asset beta here would be overall beta. Asset beta means overall beta. Asset beta is not equity beta. Asset beta is the overall beta of the company. That is weighted average beta of debt and equity you can say, or weighted average beta of all the assets on the asset side. From overall beta, you have to find equity beta. For that, portfolio management chapter will apply. You have to convert the overall beta into equity beta. Is it right? Now risk-free rate is 8.5%. Market risk premium means RM minus RF is 9%. So using your portfolio management knowledge, first you will have to find cost of equity, beta of the equity, and once you get beta of the equity, cost of equity, then apply WACC formula, then multiply by this, you will get the capital charge, minimum profit the firm should earn, then compute no PAT, and then take the final decision whether this company is able to generate economic value added or not. So write down step 1, calculation of equity beta using asset beta. Calculation of equity beta using asset beta. This formula you must have seen in portfolio management chapter. Suppose there is an unlisted company and there is a listed company. So listed company is used as a proxy firm using the data of a similarly placed listed company, we find out the beta, because overall beta of an industry will remain the same. Beta of equity and debt can change, but overall beta will remain same. Is it right? So please write down beta levered is beta unlevered upon 1 plus debt by equity into 1 minus t. 1 plus debt by equity into 1 minus t. Put the values here. Put the values 1.11 divided by 1 plus debt is 80, you can see in the problem, equity is 250, you can see in the problem, into 1 minus 0.30. Anybody wants to reply? What is the solution of this calculation? 1.36. Is it 1.36? Anybody wants to check whether it's 1.36 is right? Please check and then tell me. I have not checked. I have taken the answer from institute. Is right 1.36 or not? You're getting a different answer. One person is saying mine is 1.46. Oh my god. Just take on your calculator. First you take 80 on your calculator. Divide by 250 into 0.7 plus 1. So 1.11 divided by 1.224. Now you solve this. 0.90686. You are getting 0.90686. Wait, actually we should use a different formula. Beta of equity will be equal to unlevered beta into 1 plus debt by equity into 1 minus t. So that will be 1.11 into 1.224. Now check the answer. 1.11 into 1.224. 1.36. My mistake. You write this answer. This is right. Beta of equity has to be more because the firm is using debt. The firm is using debt. So overall beta is 1.11. Beta of equity has to be higher because the firm is using debt. Have you written 1.36 now? Have you written 1.36? I also had a doubt. So good we checked it. Now write down step 2. Calculation of cost of equity using CAPM. Calculation of cost of equity using CAPM. KE. Calculation of cost of equity using CAPM. K is equal to RF plus beta into RM minus RF. Yes, Mr. Rishabh, you are right. You can use weighted average also. This is weighted average. Weight of debt is given, but cost beta of debt you will assume 0. Then your answer will be same. Beta of debt is assumed to be 0 in this example. We have assumed beta of debt is 0. You can write it later in this example. So cost of equity is equal to 8.5 plus 1.36. RM minus RF is market risk premium. When they are using the word market risk premium means it is RM minus RF. So answer for equity is 20.74%. Answer for equity is 20.74%. Right. Step number 3, write down. Step number 3, write down post-tax cost of debt. Post-tax cost of debt. Post-tax cost of debt. KD is equal to I into 1 minus T. KD is equal to I into 1 minus T. So that is how much? 7.7%. Next, step number 4, write down. Step number 4, write down weighted average cost of capital. Weighted average cost of capital. Weighted average cost of capital is equal to KD into WD plus K into WE. So I will give you the formula, you will calculate and give me the answer. Anybody wants to answer WACC? Anybody wants to answer WACC? The answer is very good, 17.58%. Very good. Everybody got this answer? I am happy. 17.58% is right. Now write down calculation of NOPAT. What is the meaning of NOPAT? Net operating profit after tax. It is equal to PAT plus interest net of tax. It is equal to PAT plus interest net of tax. It is equal to PAT plus interest net of tax. Most of the students make a mistake here. They simply take 5,000 given in the question as NOPAT. This EVA is calculated from the point of view of long-term fund. So when you are calculating long-term fund, the profit should be before making payment to providers of finance. Is it right? The profit that we take here is before making payment to providers of finance. It should be operating profit after tax, before deducting interest, preference dividend or equity dividend. But PAT is arrived at after deducting interest. And interest is a tax deductible expenditure. So I will add back interest net of tax, because while deducting interest, you also got the tax shield on interest. So interest will be added net of tax. Write down please. PAT 5,000, interest net of tax. If it is given EBIT, then I will not deduct interest, I will directly deduct tax. But if you are given PAT, you have to do reverse working, and in that case you have to add interest. But interest is a tax deductible expense, so interest net of tax will be added. So write down 5616. Now write down my final answer. Step number 6, EVA. We always follow this format for EVA. However, this is not mandatory. This is my format. Right hand side rupees in lakhs. Right hand side rupees in lakhs. So please write down no pat. If you want to write the steps also, most welcome. Write the steps also. NOPAT is step 55616. Capital invested 33,000. Given. Question says you should present the answer in rupees in lakhs. So I have converted rupees in crore into rupees in lakhs. Okay. Then WACC we have computed in step 4. WACC we have computed in step 4, 17.58%. Capital charge will be B into C, 5801.40. So EVA will be negative. Oh my God. EVA is negative. The firm is not a wealth creator, wealth destroyer. Its opportunity cost of funds is this much, but it is able to generate only 5616. So this is the answer for this question. EVA is negative. EVA can be negative also. EVA can be negative also. Okay. One more topic we will take on which sometime you get questions in the exam is called money market instrument. Money market is a market for short-term securities. Money market is a market for securities whose maturity period is less than 1 year. Firms require funds for short period also. Like they require funds for 3 months or 6 months or 9 months or 12 months. So in that case, they will not issue a long-term bond or equity share or preference share. Then they issue money market instrument like commercial paper. Okay, treasury bill is issued by government for raising funds, or certificate of deposits are issued by banks for raising funds for short period. So those are called money market instrument. One of the money market instrument is repo, that is repurchase option. So there is a question for 5 marks asked in July 21 exam on money market instrument repo. If you know it, yes, if you know how to solve it by practicing it in advance, you can solve in the exam. Otherwise, you will not be able to solve. Okay, so just 2 more questions. Just 2 more questions. Okay, happy? I hope you enjoyed. The bank BK, name of the bank is BK. My name is BK. Enters into a repo for 99 days. So that means you will borrow for 9 days. You will borrow for how many days? 9 days with bank any in 6% government bond 2022 for an amount of rupees 2 crore. This 6% is coupon rate, and this 2 crore is face value of this government bond. 2 crore is the face value of the government bond. The other relevant details are as follows. Other relevant details. Now these are some important terms. Start proceed. This is the amount borrowed. Amount borrowed. Second leg payment. Second leg payment means repayment. This is the amount repaid. Amount repaid. What is the difference? Guess. Difference is interest, and which is paid at repo rate. Then initial margin. Initial margin means the lender will not give you advance equal to 100% of the value of security. They will give you advance which will be equal to 98.75% of the value of security. Just like in case of share. Suppose you are Adani. Okay, suppose if you become Adani, you will be in top 25 richest people. It keeps fluctuating every day also. And you have holding shares of 400 crore rupees of Adani say power. You want to pledge this share and borrow money from the bank. So will the bank give you 400 crore rupees advance, or will they give you 60% of 400 or 50% of 400? Yes, depends on the quality of the share. So normally in case of share market, they give you 40 to 50% of the value of the share as loan. But because it's a government security, the risk is negligible. So therefore they will keep a margin of only 1.25% of the value of that security and give remaining 98.75% value as advance. Okay, say yes. So this I will require in one of the answer. Days of interest accrued is 240. So this amount already includes interest accrued for 240 days. This amount includes interest accrued for 240 days. Assume 360 days in a year. Wherever interest calculation you will do, take 360 days. You are required to calculate the repo rate. Basically, you have to find out what is the rate the lender has charged to the borrower. What is the rate the lender has charged to the borrower? So this is your initial amount, this is maturity amount, this is 9 days, this is 360 days. So don't you think you can easily find out the rate charged by the lender? Simple interest, school level mathematics. Next is what is dirty price. Dirty price means come interest price. Dirty price means come interest price. Okay. And what is clean price? Clean price means X interest price. Clean price means X interest price. Okay. So we will have to do some calculation and find out come interest and X interest price. So first what I'll do, I will give you a note. Otherwise you might get confused. How this repo works, understand. Repo means repurchase option. Repurchase option. If this question comes and if you have not done it in advance, if you have not understood the concept, I have a serious doubt that we will be able to solve it. Because in the exam you can't apply your own trial and error. First part probably repo rate you can get it right. Okay. So are you ready? Repo are, the steps are today. Today what happens, the borrower goes to the lender. Borrower says I want to borrow money for 9 days. Then the lender says what is the collateral you are offering to me? So the borrower sells government security at full price. Full price means dirty price. Dirty price means come interest price. Because when you are going to sell a security, by that time interest must have accrued from last interest payment date till the date of transaction, and the bank will give you loan equal to sell proceed. Bank will give you loan equal to sell proceed. On maturity, type time right on end of repo period on maturity reverse. The borrower bank will repurchase the government security at loan repayment amount. Borrower will repurchase, that is why it is called repurchase option. You will sell it and repurchase it at the loan repayment amount. So you get back your security and you repay the loan along with interest. You repay the loan along with interest. So today you sell and get the loan. Later you repurchase that security when you return the loan. The purpose of this GSEC is that it gives security to the lender. The lender is confident that even if the borrower does not pay, I have got the government security. In India, government security is the most safest instrument. So my risk is very low. This you will discuss in your financial reporting paper also, Ind AS 109. There also we have accounting entry of repurchase option. There that knowledge you will learn is that if you have transferred the risk and reward to the other party, okay, and you don't have control, then usually we will de-recognize the instrument. But in certain cases, we do not de-recognize the instrument, we continue to recognize the instrument in our books. Okay, more about that in Ind AS 109. This is first note. Second note, write down. The convention in repo market, for coupon calculation, coupon means the interest rate on the bond, is 30 by 360. Sir, what is 30 by 360? 1 month is treated as 30 days, 1 year is treated as 360 days. This is the convention that is followed in the government security for interest calculation. Is it right? 30 by 360. However, if the institute gives number of days, follow the same. If the institute gives number of days, like in this question they have taken 360 days. So for all my calculation I will take 360 days. Second note, write down. This is for a theory question. What is repo? Theory question for 4 marks. Repo should be looked upon as collateralized borrowing. It's a form of borrowing by giving government security as a collateral, as collateralized borrowing amongst bank in the money market. The collateral being government security. One party borrows money from other party by giving government security as collateral. It is not just giving collateral, you are selling that security to the other party with a promise to repurchase it. Okay, so in fact, now this is, you must write in the exam for a theory question. In fact, the government security is not just a collateral. Instead, its ownership is transferred from borrower to the lender, because it is not just keeping it as a collateral, you are selling it. ownership is transferred from borrower to the lender. So the lender has complete safety. So the lender has complete safety. He can sell off the government security. He can sell off the government security and recover the amount and recover the amount in case the borrower fails to repay. In case the borrower fails to repay. In case the borrower fails to repay. So that is how this works. Okay, one more note, write down. One more note. Full price is equal to, full price in bracket dirty price. In bond valuation chapter you may have come across dirty price and clean price. Okay, dirty price includes interest accrued till that date. Dirty price includes interest accrued till that date. Full price is equal to clean price plus accrued interest based on 30 by 360 day count convention. 30 means number of days in a month and 360 means number of days in a year. So if it's a 6 months problem, we will take 6 into 30, 180 days and divide by 360. Okay. Now write down loan with interest. That means the loan which is actually given. The amount lent by the lender is calculated at the repo rate using actual divided by 360 days count convention. The interest will be charged by the lender using actual number of days divided by 365 days. But in our question 360 is given, so I will take 360. Okay. From the final repurchase price, we deduct the accrued interest. We deduct the accrued interest to calculate clean repurchase price. Means in bracket write X interest price to calculate the clean repurchase price. Anything can be asked in this chapter. These are a lot of technicalities involved, but those who are fund managers in big banks, mutual funds, insurance companies, government sector, they have to know all this calculation. Okay. Now I am going to come to this question. Before I come to this question, understand one party took the loan at 200,06750 and then he repaid this amount 200,31759. Okay, this is called start proceed and this is called second leg. This is called second leg, and the gap is how many days? 9 days. This gap is 9 days. So basically this is like a future value, this is present value, this is time. You have to find out what is the rate of interest charged by the lender. Is it right? So write down the formula. Calculation of repo rate. Step 1. Calculation of repo rate. By what rate of interest this amount after 9 days will become equal to 200,31759. Don't worry. Try again. So I will give you the data, you will solve. It is like a small equation you have to solve. Future value is given, present value is given, time is given. You need to find the rate. Yes, can you solve and give me the answer? Can you solve and give me the answer? Repo rate. Yes, Mehul, Rishav, Preeti, Ajinkya. What is the answer? Repo rate. Can you please reply? Can you please reply? So approximately 5% you are getting? Yes. Check the calculation yourself, but the answer should be approximately 5%, which means the lender is charging 5%. You should know that this price includes accrued interest. This price includes accrued interest, and this amount also includes accrued interest, because it's a government security, so the interest will keep on accruing every day. Now write down step 2, dirty price. Dirty price. Write down the formula for dirty price. Dirty price is your first leg into bracket start proceed. This amount 2,06,750 is the dirty price. So we have to find out what is the dirty price per 100 rupees, per unit, per bond. That is for 100 rupees face value. What is the dirty price? So it is equal to nominal value, which is the face value, into dirty price divided by 100, proportionate. But in case if there is a margin involved, so the lender is not paying you 100%. The lender is paying you only, in this example, 98.75%. So whatever is the value of your security today, the lender is only going to pay 98.75%. So the amount that is lent is equal to the dirty value of the investment multiplied by 98.75%, as the lender is not paying you the full value. He is keeping some margin. Okay, write down. I will give you the equation and you will solve. Let us see who will solve first. Come on, who will solve first? In some question, initial margin is not given. Okay. If initial margin is not given, then student is not required to write this portion. If initial margin is given, then you will write it. Yes, come on. Mehul, Sidana, reply please. What is the dirty price? You have to solve equation, otherwise how will you pass the exam? Whatever methods you have learned, apply. Yes, any answer? How much? What is the answer? Yes, the answer is 101.30. Approximately you can right? Because rounding off difference will be there. 101.29 is also right. Dirty price means it includes interest. In your intermediate debenture chapter, they used to call it cum interest price. They used to call it cum interest price. So your with interest the amount is 101.30. And what will be X interest price? That is your last question, clean price. So in the problem they have said interest has accrued for 240 days. Interest has accrued for 240 days. So if I deduct from 101.30 interest accrued for 240 days, I will be able to reach X interest price. Okay. So they have this amount includes accrued interest. If I remove the interest for 240 days from cum interest price, I will get X interest price. Last step, write down calculation of clean price, which is very easy. This they teach in your accounts chapter, investment accounting also, and that debenture accounting also. Cum interest price is equal to X interest price plus interest accrued. Dirty price means cum interest price. Clean price means X interest price. You have to find out what is clean price. I will write the equation, you will solve. Please come on, fast. Yes, solve. Please solve fast. Just one more question after this and then bye bye. Okay. Anybody who got the answer for this? Remember your happy intermediate days. You used to convert cum interest price into X interest price. It is the same thing. So the clean price is 97.30. 97.30. So in the Indian market, the bonds are traded at clean price. The bonds are traded at clean price, but one has to also pay to the seller the accrued interest, because who has held that bond? The seller has held the bond. So seller gets clean price plus accrued interest on that bond on the date of sale. For accounting purpose, the X interest amount is adjusted in the value of investment and the interest amount is adjusted in the P&L account as interest income. One more question we will solve. So that question was for 5 marks in the exam. One question artificially designed for you, not from any exam, not from any RTP, MTP, but for understanding. Are you ready? PNB. What is PNB? Punjab National Bank wants to borrow rupees 500 crore. So what is the amount they want to borrow? 500 crore via repo. Via repo means they will first sell the government security and then on maturity they will repurchase it at using its collateral. What is that collateral? 10%. This 10% is coupon rate. This is the name of the government security, GY 2032. Name of the security. 32 has nothing to do with the answer. It is the maturity year of that bond. Presently trading at rupees 103.10 clean price. Write down here clean price. Now in your book clean price is not written. Then the student will ask what we should assume. So in India, the government bonds are traded at clean price. The price quoted is clean price, but of course the buyer will have to also pay accrued interest till that date. Is it right? And when was this transaction taking place? 11th August 2017. The coupon dates are 24th March and 24th September. So when was the last coupon paid? Last coupon was paid on 24th of March. When was the transaction happening? 11th of August. So you have to, in this problem, calculate number of days interest accrued. So calculate from 24th March to 11th August number of days interest accrued. Anybody wants to reply? Number of days. Like in your 11, 12 foundation inter, you have done this kind of days calculation. How many days interest accrued? Please reply. Okay, we'll see later. And the next interest payment date is 24 September. So the transaction have taken place between two interest payment dates. So interest will accrue from 24th March to 11th August. Repo is for a period of 12 days. So you will calculate repo interest for 12 days and the repo interest rate is 8%. This is the interest that the lender will charge to the borrower. Okay. 10% is the coupon rate on the government security. You are using government security to borrow money and you are borrowing the loan at 8% interest. To show the nature of transactions involved. So in this problem, I will tell you how to calculate dirty price, how to calculate the amount of money that will be lent today, amount that will be repurchased on maturity, how much amount will be lent today, how much amount will be repurchased on maturity, and what are the clean price and dirty price today also and on maturity also. So this is a complete problem, but this problem does not have initial margin. Okay, are you ready? Yes. So please write down few lines. First write down clean price is equal to 103.10. If in the exam nothing is given, you will assume 103.10 is the clean price per rupee 100 face value. Per rupee 100 face value. Per rupee 100 face value. Then you write down step 2, interest accrued. Interest accrued from 24th March to 11th August. That is 137 days. So you will calculate interest on face value 100 rupees. Interest will always be calculated. Coupon rate will always be calculated on face value. Is the days not matching? Later on check as homework. And if it is not matching, change the answer. Let us first move ahead. So for March you will take, now at this age of your life you are calculating interest and making mistake. 30 April, May how much? June how much? July how much? 31. And August how much? 11. So how much you are getting? I think it is some different number. 140. I said no, it is possible. 140. Okay. So what I'll do, instead of 11th August, can I make it 8th August? So that my answer matches. In the exam, don't change the question, okay? But for the timing, change the question to 8th of August. Change the question to 8th of August. 140 is right, but I have already prepared the answer on the basis of 137 days. So I will request the student to change the date in the question to 8th August. It will become 8 and this will become 137. So everybody is saying 140. You are right, I was wrong. So I have changed the question. So just tell me the answer. Just tell me 100 into 137 divided by 360 into 10%. How much is that? 3.80. That means 137 I have used. Maybe mistake from my end, no problem. Now write down step 3, full price. Full price will be clean price plus interest accrued. Clean price plus interest accrued. Clean price plus interest accrued. That is how much? 103.10 plus 3.8056 106.9056. Okay, this is 106.9056. 106.9056. So some mistake in my calculation. Then step 4, write down amount borrowed. Amount borrowed. Amount borrowed is equal to, in bracket, first leg, or in bracket start proceed. Whatever terminology they use in the exam, you follow that. Is it right? Nominal value into dirty price divided by 100 into 100 minus initial margin upon 100. Write down the full formula. Whatever is not given, take it 0. Initial margin is not given, take it 0. So the answer is, your nominal amount is 500 into 106.9056 divided by 100 into 100 minus 0 upon 100. Anybody got the answer? So the amount borrowed will be equal to, write down this answer, 534.528 you are getting? Right, this is the amount you have borrowed. And on this amount, you will pay interest for 12 days at 8%. On this amount, you will pay interest at 8% for 12 days. So write down below, after 12 days, repo interest. Coupon is calculated using 360 days convention, but repo rate is calculated using 365 days. Repo is calculated using 365 days. Is it right now? To solve for repo interest, this question is reverse of the previous problem. Previous problem, repo interest rate you have to compute. Now repo interest rate is given, amount you have to compute. How much is that? 1.4059. Now write down amount repaid by PNB. Amount repaid by PNB. Amount repaid will be amount borrowed plus repo interest. Amount borrowed plus repo interest. This is called second leg payment. This is called second leg payment. So this is equal to amount borrowed 534.528 plus repo interest 1.4059. That comes to 535.94. You can round off. Okay, 9339 is okay. This is the amount repaid. Now this amount includes accrued interest also. This amount includes accrued interest also. Write down a small note. This amount includes accrued interest. This amount includes accrued interest for earlier was 137 plus 12. 12 days more have passed. 137 plus 12 more days. This amount includes accrued interest of 149 days. So what is the accrued interest component in that? How much is the accrued interest component in that? So the interest will be calculated on face value, and the convention is to take 360 days. So 10% into 500 into 149 by 360. If they ask you what is the accrued interest in the repayment amount, this is the answer, 20.6944. And the last thing that they can ask you, what is the X interest repurchase price? What is the X interest repurchase price? Tell me. X interest repurchase price. Very good, Rishabh. Come on, next. X, last thing, and then bye bye. You have repaid the dirty price minus accrued interest, reverse working, amount repaid minus accrued interest, amount repaid minus accrued interest. Yes, please reply. You have just computed both the numbers above. Why are you taking so long? Previous to answer, you have to take the difference. Anybody for 515.2395? Say yes. This is the X interest repurchase price. Okay, now just mentally revise this question yourself. You'll understand. Just revise this question mentally. You'll understand how the interest is calculated, how the dirty price or clean price are calculated. Is it right? So these are the two varieties of questions I have taken from money market instrument. So wish you all the best. Thank you very much for joining this SFM marathon revision, and I'm sure you'll do very good in the exam. If you have a doubt, you can WhatsApp on 976692180. You can email on my personal mail ID Vinod_CA at yahoo.com. Okay, and this way you can connect to me and ask for any doubts. Okay, so as I had told you, we are starting a test series. From 13th March we will start releasing the paper. There are 4 papers. You can appear in any number of papers you want, 1, 2, 3, 4. Most of the question will be new type of question which are not asked in the exam, so that you should be able to handle surprise elements. And the same thing for FR also. We will try to give new varieties of question not asked regularly in the exam, and this way you will get the shock that, oh, this is also I can be asked in the exam. Okay, thank you very much. See you soon. Bye bye.
Hello friends, now we are going to take one question from May 2022 RTP. This is question number 1 of May 2022 RTP. So those who have this May 22 RTP, keep in front of you. I'll show you the question also. This is a new question which we have not covered earlier. This question is based on short selling. Okay, so we'll solve this question in the class. There is a small mistake in the institute answer also, so that also we will discuss, right? So the question is on the screen. Question is, Mr. A is holding 1000 share of the face value of rupees 100 each of Messrs. ABC Limited. He wants to hold these shares for long term and have no intention to sell. So right now Mr. A is holding 1000 share of 100 rupees each. So the value of his share is 1 lakh rupees. The value of his share, face value you can say, is 1 lakh rupees. He wants to hold this share for long term and have no intention to sell. On 1st January 2020, Mr. XYZ has made short sale. Another party, Messrs. XYZ, has made a short sale of Messrs. ABC Limited share and approached to Mr. A to lend the share under the stock lending scheme with the following terms. So what is short sale? We have covered in the class. There is a party, Messrs. XYZ. There is a party, Mr. A, and there is a company, Messrs. ABC Limited share. So Mr. A will lend the shares to Messrs. XYZ, and Messrs. XYZ will short sell the shares. The objective of Messrs. XYZ is, if the price falls, later on they can purchase and return the shares to Mr. A and make profit. And the benefit to Mr. A is, he will get stock lending charges. In any case, he has no intention to sell. Shares are going to lie idle in his account. Therefore, Mr. A will earn some stock lending charges. Messrs. XYZ will benefit if the price of the share falls. Messrs. XYZ would lose if the price of the share goes up. So let us see what happens. Shares are to be borrowed for 3 months from 1st January 2020 to 31st March 2020. Lending charges or fees will be 1% to be paid every month on the underlying closing price of the stock quoted in the exchange. So lending charges is 1% based on closing price. So these are the closing prices given to you. These are the closing prices. Every month you have to take 1% of this as lending charges. Lending charges will be cost to the short seller, and lending charges will be income for Mr. A, the one who has lent the shares. The bank guarantee will be provided as a collateral for the value on 1/1/2020, and Messrs. XYZ, the one who does the short selling, will have to give bank guarantee, and there is a cost of bank guarantee. So who is going to bear the cost of bank guarantee? Messrs. XYZ. So this will be a cost to Messrs. XYZ. Bank guarantee commission will be a cost to Messrs. XYZ, and that is how the stock can be sold short. This is how stock lending scheme works. Okay, and what is the cost of bank guarantee? The cost of bank guarantee is 8% per annum into 3/12 into the value of the shares on 1st January 2020. If you see below, the value of the share on 1st January 2020 is 1000 rupees. So this will be the stock lending charges per share, 8% into 3 by 12 into 1000 into number of share, and the number of shares are also 1000. So you'll have to multiply by 1000 to calculate the stock lending, the bank guarantee charges. Bank guarantee charge is an expense to Messrs XYZ, income of the bank, not the income of Mr. A. So this will be treated as expense of Messrs XYZ. Okay. And then on 29th March 2020, Messrs ABC Limited declared dividend of 25%. So one more adjustment. In your original RTP, this is not printed. Later on, Institute has rectified it. So in case if in your RTP it is not printed, kindly note it down. On 29th March 2020, ABC Limited declared dividend of 25%. Declared dividend of 25%. Dividend will be on face value. So what is the relevance of this? The short seller will compensate. Short seller will compensate Mr. A for the loss of dividend. Will compensate Mr. A for the loss of dividend. So this will be income for Mr. A and it will be cost to short seller Messrs XYZ. Now they have given share prices on various date. Two scenarios they have given, scenario 1 and scenario 2, bullish. This they have wrongly treated as bullish. It should be bearish, because if you see the prices are going down. So there is a mistake in the question. So mistake is that they have written bullish in both column. It should be bearish. This is the price at the beginning. On 1/1/2020, Mr. A is holding 1000 share. So the market value of his share is 10 lakh rupees. This will be required for calculation of bank guarantee also. Okay. And these are the prices on different dates. This will be required for calculating the stock lending charges, plus this last price, that is after 3 months, whatever is the price, that will be required for calculating the gain or loss of short seller also. Is it right? So this is the data. Now what is the question? Question number 1, you are required to find out the earnings of Mr. A through stock lending scheme in both the scenario. Earnings of Mr. A through stock lending scheme. So how much stock lending charges he will earn? How much stock lending charges he will earn? That is very simple. You just have to multiply by 1% of the share prices. Can you see share prices here? You have to multiply by 1%. That will be the income from stock lending. And total earning of Mr. A during 1/1/2020 to 31st March in both the scenario. So total earning will be dividend income, stock lending charges, and the appreciation or decline in share price or decline in share price. Our institute has considered these two. They have not considered this. This should also have been considered. So there is a slight small mistake in the answer of the institute, but we will discuss that. And then the question is from the short seller's point of view, that what is the profit or loss to Messrs XYZ by shorting the shares through stock lending scheme in both the scenarios. So what we will do, first we'll solve these two questions. This is from Mr. A's point of view. This we can solve in one table only. I have to find first stock lending charge, dividend. That will give you total earning, right? So those who are interested, write down in the notebook. Others can check the answer in the RTP May 2022. This was question number 1. So first step is we'll find out the earnings of Mr. A through stock lending scheme, earnings of Mr. A through stock lending scheme and total earnings. Right. So both the answer, part 1 and part 2 in the same table. Right hand side we have two columns, scenario 1, scenario 2. So first we'll find out lending fees received. Lending fees will be received at the end of the month, which is 1% of the price of the share. So first we write down 31st March, 31st January 2020, 31/1/2020. In scenario 1 the price is 1020 into 1%, 10.20. In scenario 2 980 into 1%, try 9.8. Then next month 29th February 2020, price is 1040 into 1%, that will be 10.40, and 960 into 1%, 9.60. Continuously write. 31st March 2020, very easy. 1050 into 1%, that is 10.50, 940 into 1%, 9.40. So if you take the total now, this will give you total earning from lending per share, because I have not yet multiplied by 1000. So per share my stock lending fees earned is, add these three numbers, 31.10. Again try, add these three numbers, you are getting 28.80. This is per share under two scenarios. And how many shares have been lent? 1000 shares have been lent. So total earnings from 1000 shares. Total earnings from 1000 shares. Just multiply 31.10 into 1000. So the first answer is over, 31,100, 28,800. If only this is the question, this is the answer. For earning income through stock lending scheme, this is your answer. But in addition to that, there is another question which says total earning. Any dividend paid by the company will be compensated by short seller to Mr. A. Okay. So now you write down next line, point number C, dividend per share. Dividend is 25 rupees per share. So total dividend will be on 1000 share 25,000. Total dividend will be 25,000. You assume face value is 100 rupees. Okay. Institute in the original question had not mentioned what will be dividend per share, but in the corrigendum they have issued, they have mentioned it. So take dividend per share 25. So my total earning of Mr. A, write down total earning of Mr. A before price appreciation, because institute has not considered the price appreciation, but we need to consider that also to get total earning. If you are holder of a share, your earning will also include any appreciation in the value of the share. So right now, before considering price appreciation, your earning is B plus D. 31,100 is stock lending fees, 25,000 is dividend, 56,100, 28,800 plus 25,000 is 53,800, is 53,800. But you also add one more thing. This is ICI answer, but then we have to also add appreciation or decline in share price, this will give you accurate answer. When Mr. A had purchased the share, price was 1000 rupees on 1st January. On 31st March, the price is 1050 in scenario 1. So in scenario 1, the gain is 1000 share into 1050 minus 1000. So I will add 50,000 here. In scenario 2, 1000 share, but there is a loss. The price is 940 now. So 940 minus 1000. There is a loss of 60,000 rupees here because the price has gone down. So finally, last line, this is not written in the material. That is why I said note down the answer. Total earning after price change, after considering price change. So now you add these two also, 56,100 plus 50,000 is 1,06,100. But in second case, you have a loss 53,800 minus 60,000. There is a loss of 6,200. There is a loss of 6,200. Okay. So this is my first and second answer. Next question is from short seller's point of view. Understand, from short seller's point of view, he will have to pay this stock lending charges, that is his expense. He will have to compensate dividend. Okay. And then he will have to also enjoy or suffer the appreciation or depreciation in the price. And one more thing, he will have to pay bank guarantee charges also to the bank. So for the short seller, these three will be considered. In addition to that, the bank guarantee charges will also be considered. So now you see on the screen 31.10 plus 25 we have already calculated here, which the short seller will have to pay to the lender of the shares, and plus gain or loss we will consider. Okay, so I hope you are ready. Write down profit or loss to Messrs. XYZ. Profit or loss to Messrs. XYZ by shorting the shares. By shorting the shares through stock lending scheme. By shorting the shares through the stock lending scheme. By shorting the shares through the stock lending scheme. So first you write down gain or loss on shorting the share. Gain or loss on shorting the share per share. Gain or loss on shorting the share per share is 50 rupees, and 50 rupees is loss because the price has gone up, and here the price has gone down, so 60 rupees gain. In case of short seller, profit is made if the price goes down. Loss will be suffered if the price goes up. Then lending fees paid we have already calculated. Lending fees paid we have already calculated. 31.10, 28.8. 31.10 and 28.8. Then bank guarantee charges. Bank guarantee charges, it is based on price at the beginning at the rate of 8% for 3 months. So 20 and 20 rupees. This is based on 1000 rupees. So all these calculations are per share, per share, per share. Okay, so take the total now. Take the total now. Gain or loss per share. Gain or loss per share. In the first scenario, 10.10, and 11.20. 10.10 and 11.20. Total gain or loss. Total gain or loss on 1000 shares, multiply 10.10 into 1000, 1,01,100, and 11.20 into 1000, 11.20 into 1000. Now wait a minute, there is a small calculation error, typing error here. This should have been 101.10. Okay, this point number D, the total gain or loss per share is 101.10. Point F, write down dividend compensation paid to Mr. A, 25,000, 25,000. So point number G, net gain or loss, net gain or loss. So in first case you have 1,01,100 and 25,000. The total loss will be 1,26,100. And in second case, the total loss will be 13,800. So this was a very important question on short selling. Okay, this is a very important question for short selling, and it is applicable for all the exams to come. I hope you enjoyed. Thank you very much. Hello friends, we are going to take one important question now from RTP May 2020, and this is again a little new type of question. So you will open RTP May 2022 question number 8. Okay, and there is a small new thing that you are going to learn with this example. So I'll first present the question before you. Similar question we have done in the class, but there is one additional learning that will happen in this question. So please come to question number 8, RTP May 2022. Question is, a US investor choose to invest in Sensex for a period of 1 year. US investor means he will bring dollar and convert into rupees, and the time is 1 year. The relevant information is given below. Investment size is given in dollar. Pay attention, investment size is $20 lakh, and 1 year ago when he had invested, the exchange rate rupees per dollar was 42.50 buying rate, 42.60 selling rate. Today, after 1 year, the rate is 43.85 buying rate, 43.90 selling rate. Sensex when he bought was 3256 and Sensex today has gone up 3765. So you will recollect we have similar questions in the class. Inflation in USA is 5%, India 9%. First question is very easy, school level question. Compute the nominal rate of return to the US investor. What is the rate of return earned by the US investor? So that is very easy. He has invested 20 lakh and when he had invested the rate was 42.50 buying rate and 42.60 selling rate. He will convert dollar into rupees. So he will sell dollar, bank will buy dollar. So this will be his investment amount. And that time the Sensex was 3256. Now the Sensex is 3765. So we will assume proportionate appreciation in the value of investment. Proportionate appreciation in the value of investment. So we can find out what is the value of investment now in rupee, and then he will take that rupee back to his country. So we'll have to convert into dollar now. He will convert rupee into dollar after 1 year. Bank will sell him dollar at this rate. We will be able to calculate what is the amount received in dollar after 1 year. Compare that with initial investment of 20 lakh dollar. The difference divided by 20 lakh is the rate of return earned by the US investor. Very easy school level question. Doesn't require extraordinary knowledge. This is a new question, write down. The question is, what is the real? Real means excluding the effect of inflation. Real means excluding effect of inflation. The question gives you some inflation rate. If inflation was not there, what was the real appreciation or depreciation underlying in rupees they are asking, not in dollar. If you look at the rate given, it is given in direct quote form. That is, the rate is given for dollar. Okay. But they are asking you the appreciation or depreciation in rupees. So appreciation or depreciation we have learnt in the class how to get it. What is the rate now minus what was the rate earlier, compare them. That gives you by what percentage a currency has appreciated or depreciated. Then the next question is, what should be the exchange rate if the relevant purchasing power parity hold? So purchasing power parity theorem you have to apply. 1 plus inflation rate in domestic country upon 1 plus inflation rate in foreign country is equal to forward rate or divided by spot rate. Instead of forward rate, it is now, and spot rate means earlier. So by using this equation, we can find out what should have been the value of exchange rate if PPPT holds true. Bonus marks. Just apply the formula and you will get the answer. And next question, what is the real return to an Indian investor in the Sensex? So if I just look at the Sensex, the difference divided by opening value will give you nominal rate of return. And if I remove the effect of inflation from that, that will give me real return to the Indian investor. Similar questions were covered in the class. 2 questions or 3 questions were covered on similar lines. Okay, so first answer first. What is the nominal rate of return to the US investor? So that's a very easy question. Write down, just follow me. There is a small error in the institute answer. I will tell you that also. Part 1 of the answer is calculation of nominal rate of return to the US investor. Nominal rate of return to the US investor. Right hand side amount. First point A, investment in USD. Given in the question, first paragraph, 20 lakh dollar. And what I'll do, I'll convert into rupees by applying the buying rate on that date. So write down investment in INR, 20 lakhs into 42.50. Give me the answer. 20 lakh into 42.50. It is 8 crore 50 lakh. When the amount was invested, Sensex at that time, Sensex at T0, time 0 was 3256, and after 1 year Sensex at T1 is 3756. So what we'll assume, this amount will appreciate proportionately. The way Sensex has appreciated, the investment will also appreciate proportionately. So point number E would be value of investment at T1 in INR. Value of investment at T1 in INR. Calculate 8 crore 50 lakh, divide by 3256, multiplied by 3756. So approximately you will get this answer. Some minor difference in the last 2 or 3 digits is okay. 982,85325, minor difference is possible here. Then write down exchange rate. Exchange rate at T1. Exchange rate today. We will apply sale rate. We will apply selling rate 43.90. Now rupee has to be converted into dollar. So bank will sell dollar. We will convert into dollar. We will convert into dollar. Next point, write down amount received in dollar. E divided by F. Continue. E divided by F. Check the answer. 2238846. Now you will understand, this is what I got after 1 year, and this is 20 lakh we have invested a year ago. Compare these two. So there is a gain, and this is the nominal rate of return to the US investor. So write down nominal rate of return to the US investor. Nominal rate of return to the US investor. 2238,846. That is the value of investment now in dollar, minus 20 lakh. That was the value a year back, and divide by 20 lakh. Divide by 20 lakh. So that comes to 11.94%. So this is your first answer. Similar question already covered in the class. And this is a very basic question. Anybody can do it. Now the important question is part 2. Write down part 2, answer of part 2. Real appreciation or depreciation of rupee. Real appreciation or depreciation of rupee. Okay. In the question, if you see, they have given you spot rate now. Question, if you see spot rate now, write down given spot rate now. I am changing the presentation of this answer. because institute answer is very brief and there is a minor error also. So good student will note down so that he will understand the logic also. You are given in the question spot rate now. Now means after 1 year from the date of investment, rupees per dollar, 43.85 buying rate and 43.90 selling rate. Now they have not clearly mentioned in the question whether they want appreciation or depreciation in buying rate or ask rate. So what we'll do, we will assume that based on institute's answer that they are interested in understanding the appreciation or depreciation in bid rate, although you can apply the same logic to ask rate also. So I will solve for bid rate. Interested students can do the same thing for ask rate on your own. Why we have taken bid rate? Because institute has taken bid rate. Now this question is, if the exchange rate is given to you today, is it including inflation or excluding inflation? My question to all of you is it including inflation in both countries or not? Is it including inflation in both countries or not? So the exchange rate given to you always is after considering the effect of inflation. That means the rates have moved keeping in mind the inflation in two countries. So we have to find out if there was no inflation. If there was no inflation, suppose inflation is zero in both countries, then what would have been the exchange rate? Okay, so write a note. This is for understanding, otherwise you will not be able to understand this answer. Institute has not cared to explain this, they have only given the answer directly. So you write down, the given rate is inclusive of inflation. The given rate is inclusive of inflation. We will find out what would be exchange rate. We will find out what would be exchange rate if there would have been no inflation. We will find out what would be exchange rate if there would have been no inflation. What would be exchange rate if there would have been no inflation? Okay. So now I will take the help of PPPT. We have to learn reverse working now. This is after including inflation. So if there is no inflation, what would be the exchange rate? Okay, so we have learnt in PPPT, purchasing power parity theorem, which relates exchange rate and inflation rate. What is the formula you have learned? 1 plus inflation in domestic country upon 1 plus inflation in foreign country equal to F by S. Exchange rate now, F means exchange rate now and S means exchange rate 1 year ago. Exchange rate 1 year ago. So we are given this number. We are given these two numbers. So if there was no inflation, this is including inflation. If there was no inflation, what would have been the rate? So what I'll do, I will try to find out this missing figure. Okay, that is without inflation, what would have been the rate? So I need to find out this figure in this equation that will give me exchange rate without inflation. Right. 1 plus ID upon 1 plus IF equal to F by S. So I need to find the value of S. that is if there was no inflation, how much should be the rate? S equal to cross multiply F into 1 plus ID it should be IF divided by ID. It will reverse. Okay. IF divided by ID. There is a small typing error. I will write again 1 plus IF upon 1 plus ID. This is what we have to write. So now solve it. Solve it. After solving this, we are getting 42.24. 42.24. Okay, and the exchange rate at the beginning was 42.50 rupees per dollar, and in the absence of inflation, it is 42.24. So tell me quickly, if there was no inflation, forget inflation, if the rate is moving down from 42.50 to 42.24, what has happened? Dollar has depreciated and rupee has appreciated. Dollar has depreciated and rupee has appreciated. So this difference gives me the appreciation or depreciation in real terms, that is called real exchange rate. So next line write down, next line write down neatly. You have to remember and present also in the exam. Today you will write down, tomorrow you will revise and then appear for the exam. Notes are very important. In your own handwriting, if you write, always useful. Next line, exchange rate 1 year ago was, exchange rate 1 year ago was rupees 42.50 per dollar. Exchange rate 1 year ago was rupees 42.50 per dollar. Okay. This means in real terms, real terms means in bracket, had there been no inflation, rupee has appreciated. In real terms, rupee has appreciated. If there was no inflation, rupee had appreciated. So the real appreciation of rupee will be, now remember we have discussed in your batch, if direct quote is given, then for dollar, the formula for appreciation is F minus S by S. But for rupee, the formula will become S minus F upon F to find out the appreciation or depreciation in rupees. Okay, for dollar, if they would have asked, this is the formula. But for rupee, if they ask, the formula we have discussed in the basics of Forex and we have proved it also. Okay, so we'll use this formula, real appreciation of rupee S minus F by F. So rate given to you in the question 42.50. This is real exchange rate in the absence of inflation, 42.24 divided by 42.24. Now institute has made a small mistake here. They have divided by 42.50, whereas the correct formula is to divide by F, discussed in your basics chapter. Solve it. You will get 0.6155%. 0.6155%. I have written a note for you. Later on, if you compare our answer with institute answer, there is small difference here. So you follow this. Note, write down, institute has taken rupees 42.50 per dollar. Institute have taken rupees 42.50 per dollar in the denominator. Here they have taken 42.50, which is incorrect. Underline, which is incorrect. Now, in suppose one extra thing I am discussing here, if they would have asked for dollar depreciation, this is beyond the question. Suppose in your exam they change the question and say dollar depreciation, then the formula would be F minus S upon S, F minus S upon S, and your answer would have been 42.24 minus 42.50 divided by 42.50. If they ask for dollar depreciation, then this would be the answer. Approximately same, but not 100% same, because of the base effect. The base number is different, and therefore your answer would be also different. So if I go by this, the answer is 0.6117%. Minus sign indicates depreciation in dollar. So this was something important. First you find out the real rate and then use that for appreciation and depreciation. Next part of this question is, what will be exchange rate if PPPT holds true? Write down, exchange rate if PPPT holds true. As per PPPT, 1 plus ID upon 1 plus IF equal to F by S. F means you have to find now, S means it was 1 year ago. They have not mentioned whether I need to find for bid rate or ask rate, but this is simple. So what I can do, I can solve for bid rate and ask rate both. Easy, not at all difficult. Ready? Write down. So I need to find out what will be forward rate. I need to find out this. This is my question mark. So forward rate is equal to spot rate cross multiply into 1 plus ID upon 1 plus IF. So for buying rate, spot buying rate is 42.50. Check the question. Into 1.09 divided by 1.05. So that is 44.12 rupees per dollar. And selling rate, similarly find selling rate. In the question you are given exchange rate 1 year ago, 42.60 into 1.09 divided by 1.05. Check the answer, 44.22 rupees per dollar. Therefore the final you will present like this. Exchange rate would have been 44.12 dash 44.22 rupees per dollar. So if PPPT holds true, this should have been the exchange rate today. There is one more question, that what is the real return to Indian investor in Sensex? Now there is no role of exchange rate here, because you are an Indian investor, you are investing in Sensex. So first we'll find out nominal return by just comparing the opening and closing index, and then we will remove the inflation effect, and we'll get the real return. So write down step 1. Step 1, write down nominal return to Indian investor. Nominal return to Indian investor just compare closing and opening Sensex, divide by opening Sensex 3765 minus 3256, divide by 3256 into 100. Check. Anybody? Answer. Come on, fast. 15.63. Very good. And then step 2 is real return to Indian investor. Real return to the Indian investor. The formula is 1 plus nominal return, 1 plus nominal return upon 1 plus inflation rate minus 1. 1 plus nominal return, 1 plus 0.1563. This is the nominal return upon 1 plus inflation rate. Inflation rate is 9% in India, minus 1. Solve it. The answer is, check the answer, approximately check 6.08%. Are you getting 6.08%? Right. So this is the answer of this very important question. Do it properly, revise it, and it can be asked in your exam. So thank you very much.
Are you feeling overstressed by your CA syllabus? Get the best CA revision lectures by top CA leaders, specially designed to boost your confidence and knowledge. And the best part of the lecture is that they are available at super affordable prices and available at any time, anywhere. So hurry up and place your order from our website Vinod.in. It is a perfect solution for your last minute revision.